Welcome, everyone, to The Deep Dive. We're your go-to for breaking down the earnings calls that matter.
Glad to be here.
Today, we're jumping into Indigo's recent Q1 results for fiscal year 2026. That call happened just on July 30th.
That's right. And the initial market reaction was interesting. A little dip at first.
Yeah, slight wobble, but then confidence just surged back, didn't it? We saw a pretty significant rally, lots of analyst support.
Exactly. So our job today is really to unpack the why behind that shift. What did the market see beyond those first numbers?
It's often the case, isn't it?
Yeah.
The headline figures don't tell the whole story.
Not at all. The market quickly reevaluated, looked at the underlying strength the strategy management laid out.
A vote of confidence in the long game, maybe?
I think so, even with the short-term hits they took.
Okay, so let's lay out that snapshot. Q1 FY26 results, financials first.
Sure. So GAAP EPS came in at 56.31. That was actually a miss by about 1 rupee.
Okay, and revenue.
Revenue was 20,496 crore, also a slight miss, about 311 crore short. But importantly, still up 4.7% year over year.
Still growing then, but net profit.
That's where the hit was more noticeable, 2,176 crore, which is down 20.2% compared to last year's Q1.
Right, so a couple of misses, profit down.
Right.
Yet the market rallied. That's the puzzle.
It is. And I think the answer starts with the operational side. The passenger numbers were really strong.
Tell us about those.
They served 31 million passengers. That's up a huge 11.6% year over year.
Wow, 11.6%. How does that compare to the rest of the industry?
That's the key bit. It's basically double the industry average growth, which is around 6%. So they're really pulling ahead in terms of volume.
Okay, massive passenger growth. What about load factors and yield?
A bit softer there. Load factor was 84.6%. That's down slightly, about 210 basis points. So planes marginally less full on average. And yield, which is like the fare per kilometer, was 4.98. That's down 5%.
So carrying way more people, but maybe it's slightly lower average fares and with a few more empty seats than last year.
Precisely. But that sheer passenger growth number, I think that's what really underlined their market dominance for investors.
So how did they manage that kind of operational performance when things seemed tough?
Yeah.
You mentioned challenges.
Oh, definitely. Management themselves called Q1 an external shock quarter. And when you look at what hit them, it's easy to see why.
Like what specifically?
Well, you had geopolitical stuff, the India-Pakistan tensions, airspace closures in the Middle East. That meant longer routes, more fuel burn, cancellations, real operational headaches.
Right, those detours add up.
They really do. Then you had the tragic Air India crash, AI-71, and also that terrorist attack in Pahuam. Both events, understandably, impacted travel sentiment, demand.
Yeah, absolutely, a tough environment.
And on top of all that, Cyclone Remal hit in May, forced cancellations across 10 airports for well over a week.
Just one thing after another.
Exactly. So the fact they still called it a resilient quarter and delivered that passenger growth, it really does speak volumes about their network strength and how they handled it all.
It certainly paints a picture of operational resilience. And what about costs? Did those external shocks blow costs out?
Well, this is another interesting part of the story. They actually showed some pretty impressive cost management, especially on fuel.
Okay.
Their fuel CASK, that's cost per available seat kilometer for fuel, dropped 22% year over year.
22%? That's huge. How?
It was a mix of things. Lower global fuel prices definitely helped, but also smart contract negotiations. And they've been redelivering older, less efficient aircraft.
Getting rid of the gas guzzlers.
Basically, yeah. And even on the non-fuel side, costs were pretty well contained.
What did non-fuel CASK look like? That covers crew, maintenance, airports.
Right. That only went up 2.5% year over year, which, considering those war-driven reroutes add costs, management felt was quite disciplined.
So holding the line on cost despite the chaos.
They flagged protecting margins as a definite green flag. Although they did also mention rising airport charges as a potential red flag to watch. Costs they don't directly control as easily.
Makes sense. So this cost discipline, it's not just about surviving Q1, is it? It sets them up for future plans.
Absolutely. It underpins their capacity and fleet strategy moving forward.
So what's the plan there? Let's talk Q2 guidance first.
Okay. For Q2 fiscal 26, they're guiding available seat kilometer, or ASK, growth in the mid to high single digits.
So a bit slower than the 16% growth we saw in Q1.
Yeah, a conscious moderation. Q2 is seasonally weaker anyway, the monsoon season.
Right.
Plus, it gives them a window for maintenance, getting the fleet ready for what they expect to be a stronger second half of the year.
But they're sticking to their full-year goals.
Oh yeah, absolutely firm on early double-digit capacity addition for the full fiscal year. Q1's 16% growth puts them well on track for that.
What about the fleet itself? Those engine groundings, the Pratt & Whitney issues?
Still a factor. The number of grounded aircraft remains stable, sort of in the 40s. They're managing it. They also returned 16 damp-leased aircraft this quarter.
Remind us what damp-leased means.
Sure. It's basically renting the plane along with the crew, maintenance, insurance. Returning them means they're relying more on their own fleet and resources.
Okay. And connected to that, there's a bigger strategic shift happening with their fleet, isn't there? Towards ownership?
Yes, exactly. They're moving more towards finance leases instead of operating leases.
So less like renting, more like buying on a long-term plan.
That's a good way to put it. It signals they want long-term control of the assets. It ties into potentially lower costs down the line and definitely synergies with their MRO plans.
The maintenance, repair, and overhaul initiative. We'll come back to that. But this ownership idea, it links to their big international push, right?
Directly. Their goal is ambitious, no doubt about it. Increase international capacity share from the current 28% to 40% by fiscal year 2030.
40%. That's a huge jump.
Yeah.
How are they planning to get there? Wide-body aircraft are key, I imagine.
Absolutely. They've signed that MOU with Airbus for 30 firm A350 wide bodies, but those deliveries don't start until 2032.
So quite a way off. What about the meantime?
That's where the clever part comes in. They've got an agreement for 6 wide bodies on damp lease from North Atlantic. One's already flying, the rest are due this fiscal year.
So using leased wide bodies to bridge the gap.
Exactly. And it's already enabling new long-haul routes. Mumbai-Amsterdam daily, Mumbai-Manchester 4 times a week. Big steps for them.
And new products on those routes, too.
Yes, first-time hot meals. And they're rolling out their stretch product, the extra legroom seats. Plus, London and Copenhagen are planned soon. They're serious about Europe.
That stretch product, are they expanding that elsewhere?
They are. After testing it on Delhi-Bangkok, it's now going on to other regional international routes, Bangkok, Singapore, Dubai, Phuket, from Delhi and Mumbai. It shows they're evolving beyond just pure low cost.
Listening to passengers wanting a bit more comfort on longer flights.
Seems like it. And they're also boosting connectivity through codeshares.
Right, partnerships with other airlines. Who are they working with now?
It's becoming quite a network. KLM for Europe and the UK, Japan Airlines for connecting Southeast Asia to Tokyo, Jetstar for Australia and New Zealand, Delta for transatlantic, Virgin Atlantic for UK, India, and North America routes.
So you can book an Indigo ticket and end up flying part of your journey on KLM or Delta, for instance.
Exactly. It extends their reach massively without needing their own metal on every single route. A really global network taking shape.
Okay, that's the international side.
Yeah.
What's happening domestically? Are they still focused there?
Oh, absolutely. They're not taking their eye off the ball at home, still growing and densifying the network. Launched 2 new destinations, Hindon and Adam.
And becoming a lounge carrier. That sounds new for Indigo.
Yeah, at the new airports like Javur and Navi Mumbai, it's another sign of product evolution. But the core domestic strength is that density. They say 90% of India's population lives within 100 kilometers of an Indigo airport.
90%. That's incredible reach. A huge feeder network for those international flights, too.
Definitely. And supporting all this is that MRO joint venture you mentioned earlier with Bengaluru Airport, BIL.
Right, the in-house maintenance plan. How significant could that be?
Potentially very significant for costs. They reckon it could cut CASK ex-fuel, so non-fuel costs per seat kilometers, by 80 to 100 basis points.
So almost a 1% cut in non-fuel operating costs.
Yes, by doing heavy maintenance checks in-house in India. That means cost savings and, crucially, quicker turnarounds, getting planes back in the air faster.
Maximizing asset use. Makes total sense.
And they're looking even further ahead with Indigo Ventures.
Their new VC arm.
Yeah, made its first investment in J Aerospace, a Hyderabad startup focused on aviation innovation. Shows they're thinking about future tech and efficiencies too.
Plus, the loyalty program and credit card keeping customers sticky.
Right, 3.8 million members in the loyalty program, co-branded card with Kotak Mahindra. It all feeds into that customer base.
Okay, so pulling all this together, the resilience, the cost control, the huge international ambition, the domestic strengths, the MRO plan, it starts to become clear why the market rallied, doesn't it?
I think so. The initial dip was maybe a knee-jerk reaction to the headline profit miss. But then investors looked at the strategy, the execution, the forward guidance.
And the share price jumped over 3% the next day. Heavy volume, too. Brokers like Nokalal Oswal Alara reiterated buy ratings, targets up near 6,900.
Exactly, a strong endorsement. And Indigo's stock has been outperforming the Nifty 50 quite significantly.
By how much?
Over the last 3 months, it was up 12% versus the Nifty's 5%. And over the year, nearly 30% up versus the Nifty's 20%.
So the market definitely sees something special here.
Well, they're seen as this liquidity-rich player in a market where capacity is actually quite tight for competitors, partly due to those engine groundings affecting others too. And with crude oil staying relatively tame, below $70.
Their scale and fleet mix become a real advantage.
A relative advantage, absolutely. They can potentially consolidate their position.
So, looking ahead, what are the key things investors or anyone interested should watch for? The catalysts.
Okay, near term. Mid-September traffic data will be interesting. See if that seasonal recovery kicks in as expected.
Right.
Then late October, you've got the Q2 earnings print. That'll be proof of whether they're delivering on the ASK growth and managing costs.
Any index changes?
Potential Nifty 50 inclusion is always talked about. That could bring in more institutional money if it happens.
And the engine situation.
Yeah, updates on the Airbus engine return schedule. Anything that frees up more of their own aircraft is positive.
So the narrative really has shifted, hasn't it? From just getting through the tough times
to accelerating this big international push. It's a much more forward-looking, growth-oriented story now.
A compelling pivot, leveraging their strengths.
Definitely. Discipline management, but aggressive expansion plans. It's a combination the market seems to like.
All right, it's that time in our deep dive. Time for our This Is Not Financial Advice segment. Just a speculative idea, purely for entertainment, get you thinking.
The outrageous but plausible idea.
Exactly. So we've talked about Indigo's growth plan. The analyst targets around 60,900, which are already pretty bullish. But here's the pitch. What if the real dark horse catalyst is something bigger? Something unannounced.
Okay, I'm listening.
Think about their cash pile. Over $348 billion in free cash. Huge liquidity.
Right. Massive war chest.
And think about their urgency. They want that 40% international share by FY30. That's aggressive.
Yeah.
And the global aviation scene. It's capacity constrained. And let's be honest, some smaller regional airlines are struggling financially.
So you're thinking M&A. That seems very unlike Indigo's usual organic growth style. They've always been about building it themselves, very disciplined capital allocation.
That's why it's outrageous but plausible. Imagine Indigo using a chunk of that cash for a surprise, all-cash buyout, a smaller, maybe struggling regional international carrier.
Which one, though, and why?
One with strategic route rights into key markets they want, maybe a fleet that, even if not ideal long-term, could be integrated relatively quickly to just grab that capacity now.
So leapfrogging years of organic growth, buying their way into that 40% target much faster.
Precisely. Capitalize on market dislocation, use their financial muscle, become that dominant global player before the A350s even arrive in 2032. It's a bold, disruptive chess move.
Wow. Okay, that is bold, but the risks. Huge integration challenges, right? Culture clashes, different fleet types, regulatory hurdles. Merging airlines is notoriously difficult and expensive if it goes wrong. It could burn through that cash quickly.
Absolutely. High risk, high reward. But the potential upside,
Yeah.
instantly acquiring market share, crucial airport slots, those valuable route rights. Maybe the prize is just too tempting in this current environment, using their balance sheet as a weapon.
It would certainly be a game changer, turning market challenges into a unique offensive opportunity. It definitely makes you think about how they might deploy that cash beyond just buying their own planes.
It's a scenario to ponder anyway. So let's quickly recap the main points from today's deep dive.
Sure, Indigo delivered a really resilient Q1, despite facing a ton of external shocks.
Showed impressive cost control, operational discipline.
And critically, they're making a very aggressive pivot towards international expansion, targeting that 40% share while still leading domestically.
Management sounds confident about a strong rebound in the second half of the year, Q3 and Q4, really playing the long game in Indian aviation growth.
Definitely laying foundations, not just reacting.
So the final thought we want to leave you with today. As Indigo invests heavily in MRO and shifts towards owning more aircraft, where will its biggest future competitive advantage lie? Will it be more about that operational efficiency they're known for, or will it increasingly be about the strength of their growing asset base?
An interesting question indeed. Efficiency versus assets.
Something to mull over. Thank you for tuning into the deep dive today. We hope this has helped you get a clearer picture of Indigo's recent performance and future path.
Yeah, always good to dig into the details.
We'd love to hear your thoughts too. Feel free to share them. Until next time, keep digging deeper.